everyone. Thank you for joining us once again here at Seafood and Brew for our economic briefings. And for this briefing, we're going to look at the fourth quarter performance of that community bank benchmark group. And just to remind you, that benchmark group is made up of banks with assets between $100 million and $5 billion. So overall, when we look at the change quarter over quarter in the balance sheet for these institutions on an aggregate level, we can see the overall asset growth increased just under 2% at 1.83%. Loan growth, total loan growth up under 1% at 0.82%, but a lot of that was due to the forgiveness of the PPP loans. So we saw net of PPP loans up 2.42%. Not a bad growth rate in terms of that loan portfolio for the quarter. Deposit growth up 2.28%. We continue to see within the quarter the deposit growth there. Now, I will say with the banks that I've been talking to, so far this quarter, the first quarter of 2022, we're starting to see a little bit of a pull-off in that growth in deposits. And we see that also on the overall level of bank deposits for commercial institutions. We look at the chart of that indicator and we start to level off in terms of the level of growth in deposits. So throughout the first quarter here, it'll be interesting to see if we see that trend continue, if we have an overall flat level of growth for the first quarter on that deposits. But looking at the income statement, overall ROA has gone down for each of our subcategories here, subchapter S, stock banks, and mutual institutions. We can see the subchapter S going from a 144 in the third quarter, dropping down to a 1.11. The stock group going from a 109 down to below 1% at 0.93. And then that mutual institution pulling off just 1 basis point from 0.6 down to 0.59. Now, when we look at it collectively for these institutions, overall we saw the average return on average assets go from a 124 down to 0.99. The median, which tends to be a little lower than the average, went from a 115 down to a 97. So we saw both decline by a fair amount quarter over quarter. We dive into why did this happen. We can look at that DuPont analysis, looking at it as a percent of average assets. Overall, we had about 12 basis points pull off because of margin. We saw yields on earning assets coming down about 15 basis points, while we had a little bit of an offset from the lower interest cost of about 2 basis points. So that was a benefit overall, but we did have that reduction in that interest income. Now, a portion of that, of course, and we'll see this when we look in the yield, would be those PPP loans. The overall level of fee income that was brought in the third quarter was pretty strong, and that kind of elevated that third quarter number. And then therefore, the fourth quarter, that net interest margin came down, and we'll see that in just a minute. But when we look at provisioning added about or took away about 1 basis point. And then the next big item would be the overall level of net overhead, which contributed about 17 basis points from that pull-off in ROAA. So that net overhead, the difference between non-interest income and non-interest expense. But overall, when we look at the net interest margin, while it leveled off in the third quarter, where it ended at 3.35, for the fourth quarter, we saw that continue to decline. down to 2 or 3.22. So we saw a substantial decline in here in the overall level net interest margin. And we see why this yield on earning assets fell from a 360 down to a 346. So that was a substantial decline, while we saw the cost of funds come down just 3 basis points. And we knew we were going to see these type of numbers in the third quarter just because cost of funds is about as low as it's going to go. And we knew we still had some downward pricing pressure on that yielding earning assets. And I'd go so far to say that we potentially continue to have that downward pricing on the overall level of yielding earning assets. So I would not be surprised if in the first quarter release of the data, we see a continuation of the decline in net interest margin. Now that being said, it's going to create that margin compression moving forward. And I think that margin compression is going to continue throughout most of 2022, if not longer. When we're looking at the cash position for institutions, this is the cash on the asset side, the interest-bearing cash. Notice we continue to see this elevated level up to 11.31%. That is a drag right now on the yielding earning assets because these monies at this point are earning less than 10 basis points. So that's a significant pull-off compared to where it was back in 2018 when it was 5.75%. So we had a doubling of the respective measure of interest-bearing cash balances on the asset side of the balance sheet. So that is having a drag on that earnings. And the question is, when can we push those funding out to generate additional income? We will see a bump if the Fed starts to increase rates in March, which we're anticipating that to happen. But it's not going to be a substantial increase in the overall level of income generated on those balances, and it's not going to have an impact on the overall level of net interest margin. When we're looking at net overhead, we already saw that increase up to that 1.82. It's still historically not a bad place to be at that 182. When we look at the components here, we saw non-interest expense as a percentage of average assets increase quarter over quarter from that 237 to the 245. Now, the fourth quarter, we tend to have bonuses and different expenses that come into play. So that's a natural progression when we typically see that happen in the fourth quarter. So nothing really concerning there. When we look at the non-interest income, we saw that fall about 3 basis points quarter over quarter, from a 0.55 to a 0.52. So it continues that downward pressure. And this is going to be that issue, right? When we start to see some of the larger banks come out with no overdraft fees. So we're going to start to see that competition an issue with the overall level of non-interest income having that pressure. In terms of risk seems to be fairly stable. Year over year, we're down actually a little bit on that risk score. When we look at the individual's levels of risk, of course, liquidity risk continues to be very low. Capital risk rate at that moderate to low zone. Credit risk has been improving, and this is the worry this was the worry in 2020 with the pandemic starting, but we never saw that credit risk really spike at this time. Earnings at risk is where we see the progressive increase in it, just because that's the volatility of that net interest margin. And with that net interest margin continuing its downward trend throughout the last couple of years, that is where we're seeing this overall increase in this earnings at risk. In fact, we're getting up to the point we're in the upper moderate zone on that earnings at risk. So this is going to be impacted by that yield curve. And our expectation when we're looking at the yield curve is that there's going to be a flatter yield curve as we progress throughout 2022. We're going to see the short-term rates increase, and we've seen them increase pretty substantially over the beginning of the year. But we're not going to see the same level of increases on that long end of the curve. So we're going to see that natural tightening of that slope. It's going to become very, very narrow, and potentially even a flat yield curve we could see. So it'll be interesting as we move through 2022, as we see that interplay between the long and short term interest rates. But overall, I do believe we're going to go into this situation where we have a much narrower yield curve than we had over the past couple of years. So that's what we have for you today. We look forward to talking to you again in the near future when we look at the overall level of where interest rates have come and that economic numbers that are so important for our industry. Have a great day, everyone.